The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. First, let's talk about the consumer. During COVID lockdowns and government stimulus, we saw savings rates increase dramatically as people were locked in and not spending as much as they normally had been. And now we see savings rates dropping pretty dramatically as the excess savings that people accumulated during COVID, which accumulated to more than $2 trillion, have been spent down at a pretty dramatic rate, and people are just about out of money, it looks like, as we see people's revolving credit outstanding starting to rise again. So as you know, if we step back, the Fed had raised interest rates dramatically over the last year and a half to try to slow down inflation coming out of COVID. But a lot of economists predicted a recession. But what we saw is that the labor force was so strong as employment remained high that it prevented that so far. When we look at the unemployment rate and wages, we have a very, very low unemployment rate relative to history. And we have still quite a bit of wage growth, although we see that falling. People had been seeing wage increases of above 6%. They've now fallen to just above 4% as the typical wage increase that we're seeing at this point. And we're seeing inflation, which had been very high, fallen pretty dramatically down to the 3% range. And it's now actually starting to rise a little bit as we see materials prices, in particular oil, increasing over the last month, although it's still come down dramatically from where it was. So it's kind of a mixed bag at this point as we try to look ahead and predict what's going to happen. Is that recession that was predicted still coming, or is the economy, which appears to be still quite strong, going to keep on chugging along? Construction sentiment still appears pretty good. The architectural billing index is holding up okay, and new housing starts remain fairly stable over time despite these high interest rates. So it's kind of a wait and see at this point to see where we go, where the economy goes. High interest rates are expected to continue to take their toll and to slow down new projects and kind of be a headwind going forward. And markets are mixed as we look year to date. We see the stock market rebounding fairly strongly, up 16% among large companies, but small companies are performing much less well as we look at what we typically see going into a recession. Small companies, because they're smaller and more vulnerable, get hit the hardest with more challenges around credit and things like that. They also tend to rally back strongest coming out of a recession, and we don't see that rally yet, which tells us we could still be looking at some concern ahead with the potential for recession. If we look at real estate, we see that that's down modestly year to date, and the bond market, again, because of the increases in interest rates we've seen, is still negative. So again, got to take a wait and see approach, encourage our clients to be cautious, but to work hard to continue to grow their businesses. And if we can help you in that endeavor, please reach out to us. We're happy to chat. Thanks.